I would say as close to zero as anything could be in this business of forecasting. You know, the no landing reminds me a lot of global decoupling back in 2008. I don't think that there's a get-a-jail-free card for the economy in the context of the most acute Fed tightening cycle into the most inverted yield curve since 1981. We just haven't seen the full brunt of the rate shock just yet. The economy, notwithstanding January, you know, nothing moves in a straight line. You know, we came off back-to-back quarters last year, Q3, Q4, where real private final sales were very weak. They were flat in the fourth quarter. And actually, if you look at GDP on a monthly basis, as of December, it was actually fractionally negative. So we had a nice little pop in January. It doesn't tell us much about what's going to happen down the road. But I think the no landing is, I mean, it's a nice fairy tale, but that's what it is.
Well, I forgot about global decoupling until you reminded me of that. That was a big move back in the day. Steve, on what basis, though, do you think Fed officials, again, not that they're voting members, but are out here now talking about the need for a half-point hike? Do they just look at CPI and retail sales and GDP and say, you know, if we extrapolate this, the economy's stronger than expected, inflation's still high?
So I think that a half-point hike is a minority view on the Fed right now. A lot's going to depend upon the upcoming jobs report, the upcoming inflation report. Perhaps it'll show the inflation that David believes is in train. I think that's why they're more likely, I think, and by the way, that's the way the market is priced, for a quarter-point hike in March. And the way the market's betting right now, Kelly, is more likely, if there's going to be more inflation and faster growth, to do another quarter in June. That's where I see something like a 60% probability of that extra quarter out there. I think the Fed is aware of the ideas that David is giving us today that I think are very important and an interesting way to look at the economy. But I think where they see the risk is in inflation being too high, not in the idea that the economy is too weak. They look at the job market and they see pretty strong job growth there, and they see a concern for wages and the service sector.
And Dave, just to zoom out for a second and put this in context, we do have China easing right now while we are tightening. We have them reopening, coming into the economy, and that's why I thought the lack of response in oil is interesting. That you could obviously make the case for being 20% higher from here than it is, and it's not. What do you think is going on in terms of the global effect that China is having right now?
Well, look, the China effect in the markets got priced in right away. It's still staring us in the face. And you would think, you know, if there's one sector outside of travel tourism and maybe Gucci bags in Europe, that it would be very beneficial for jet fuel demand in particular. So there may just be weakness in other parts of the world, or it could be some expectations of more SPR drawdowns. But I'd say that it has been a big surprise. But look, I'll just come back, you know, besides the oil price, I mean, even before oil prices started declining this week, they were still down 30% from the highs. Where's the inflation in oil? The Baltic Dry Index is down 90% from its peaks. The Baltic Dry Index is actually lower today than it was pre-COVID. The problem for me, looking at the inflation situation, is that it's a lagging indicator. I mean, you mentioned the LEI that came out today. The lagging indicator was up 0.2. The coincident indicator was up 0.2. The LEI was down 0.3. What do you want to focus on?
Right.
Service sector inflation that everybody is focused on, including the Fed. So the Fed's focused on it, so we have to focus on it. But it has to be known that service sector CPI is one of the components of the index of lagging indicators. And that's the one thing we know about inflation, that everybody is gut-wrenched over inflation. Inflation peaks 6 months into the recession, and then it bottoms 15 months into the recovery. I mean, if you're looking at inflation after a recession ends, you'd be thinking we're still in recession. So I don't know. I think the Fed, look, to the Fed, it's more about financial conditions in the stock market. I mean, the one number that nobody talks about that came out at the beginning of the week was the New York Fed's own consumer expectation survey. And it showed that the three-year median consumer inflation expectation went from 3% in December to 2.7% in January. Well, what do you know about that? A hot January CPI, and yet three-year consumer expectations on inflation went down to the lowest level since October 2020. And nobody talks about that. I think that tells me that the household sector is looking through whatever it is we saw in January as really more of a statistical artifact than anything that's really happening on the inflation side. The inflation side being driven largely by the way, half of the core CPI are imputed guesswork by the BLS. If you're taking a look at the things that we can see, touch, and feel, you're taking a look at, say, the core goods CPI, which are real transaction numbers.
Yeah.
We're entering into a very significant disinflationary period right now.